Hi, and welcome to Midas Investing. Today we're going to be taking a look at Smith& Wesson brands, ticker SWBI, founded in 1852 and being one of the largest and most prolific arms manufacturers in the world. It needs no real introduction, but Smith& Wesson brand sells under its Smith& Wesson as well as M&P and Gemtech brand titles. We've covered them on the channel before, and in the time since, they've become a pretty major position within my portfolio, and I'm excited to cover them again here today while I still do maintain that position. It's worth noting that there is obviously a lot of geopolitical concerns surrounding an arms manufacturer, and this valuation will essentially assume that all of those worries are going to be left as is, and that there is going to be no major real changes to regulations or taxes or any legal concerns surrounding arms manufacturers. So if you have any concerns related to those things, you should discount my valuation appropriately based on that information. But it's worth noting that these concerns and my belief that they're not likely to actually materialize is one of the reasons that I think this value exists in the first place. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So taking a look at the industry as a whole, breaking it up into some of its major players, I found this image, which unfortunately goes all the way back to 2016. So it is definitely a little bit of dated information, but it still gets my point to which I wanted to show, which is that in general, the gun market is bifurcated between a few very large players. It just happens to be coincidentally that those larger players are the public players being Ruger and Smith & Wesson, as well as Remington Outdoors listed here as well. But many of the smaller players within the highly fragmented gun space are actually privately held. So there isn't necessarily a whole lot of comparable companies to compare them to. And even the other public manufacturers themselves, that being at an even smaller size, makes them even less comparable. Now, one interesting thing about the firearms industry is that there's actually a lot of data that you can use to try to build up projections for the future. This article and articles like it from shootingindustry.com gives general overviews of where the industry stands on a yearly basis. I use a lot of information in this article for building up my model. They include a lot of information about the production numbers for firearms, and also bifurcating it by different type. You can see here how handguns in general are the more preferable form of firearm, with shotguns really starting to dwindle in their popularity over the years, as well as it gives information about the actual market share statistics based off of the actual manufacturing numbers themselves, going down even to all the top 100 producers. But what they also include is information that gives us a gauge on demand and sales itself. There is the instant criminal background check service, which gives us a base level number of background checks that are being done on a regular basis. However, not all background checks are for new gun sales. So there is the National Shooting Sports Foundation, NSSF, that does an adjustment against these numbers to try to get a gauge for how many background checks are effectively for new guns and new purchases. So this NSSF number adjusted for the NICS background checks is essentially a proxy for sales. It isn't actually sales within the industry, but it is used as a pretty strong proxy for changes within sales for the industry itself. And the interesting thing about that is that that base level number done by the NICS, you can actually get a hold of that information from government websites, in particular from the FBI website. On a monthly basis, they report these numbers, not just on a monthly basis, but they even give you down to specific states and locations, and plenty of other disaggregation of the information. So the point is, on a pretty regular basis, you can get a pretty forward looking measure of what the demand for firearms is likely to be. Now we can come over to the spreadsheet where I built my model, and we can show you how some of this data checks out both against its kind of historical trends and how that's going to work into the actual model that I built. So right here in the blue bars, we have the total background checks being done according to those reports that I have. Unfortunately, I only have data up to a certain amount of years. And weirdly enough, I have numbers on the adjusted numbers going back much further than that. It's kind of just weird how that is the information that I was able to get a hold of. But nonetheless, you can see in general that there's kind of just a proportion between the two. That's kind of the thing I wanted to generally point out. And we actually have that with this this kind of maroon line on the right hand side in percentages. You can see in general, it's, I don't know, about half or so, maybe up to close to 60%, down to close to maybe even the 40% range at some points, but generally about half of the total background checks that are being done according to this NSSF adjusted demand gauge, potentially sort of like a sales figure. And you can see that kind of going back even further than this. The other line that I have right here is the total checks, the total background checks, that's why it's in blue, as a percentage of the total population of the United States. So you can see in general, it kind of hovers around this 10% line. So The way you can kind of think about this is at least over the few years we have right here, but you can see it seems to be pretty reasonably consistent as in terms of a trend. And I'm going to extrapolate further to assume that these trends are both true in the past and into the future, which is to say that about 10% of the population over any given year is likely to have background checks being done. That can give us a gauge of how many background checks there's likely to be based off of population growth. And then about half of those background checks are being done for the adjusted figure. And then we can take that as a gauge again for our demand for the total amount of gun sales in any given year over time. So this is going to be how I'm going to build up that model. Then coming to take a look at production, the other half of the industry over time, I have a little bit more consistent data going back over a longer range of time. The green bars, we have total production of total amount of firearms being produced in the United States as a whole industry up through 2020, going back to 1999. And you can see how well the two sort of trend with each other in terms of the overall co-movements of the size. I will point out that the absolute numbers are pretty significantly different. Just pointing back, for example, in 1999, we have in total about 4 million, or actually I say 2000 since the other chart only goes to there, about 3.7, 3.8 million in 2000 for total production, versus in 2000 we have the NSSF adjusted number is 7.5 million. So you can see that in general, the demand was higher than the production. If we move up to maybe a more recent year, we can see that, for example, maybe in 2020, we had the NSSF adjusted number of 21 million in terms of the demand number, and then production in 2020 we had about 9.7 million in total. So you can see in general there's a larger amount of demand relative to production, which sort of makes sense if you understand anything about firearms. If they're being well maintained and well kept, then they actually can last for a very long time. In general, in fact, I've seen some articles talking about this, trying to talk about the average wear and tear of guns, that at the end of the day, people replace guns when they want to, when it's fashionable to do so, not so much necessarily out of a necessarily real need. Typically, a gun lasts about as long as a human does if it's well maintained, if not longer. So the point is, in general, there's plenty of guns out there already in stock. It's not like there's a whole bunch of guns that are being worn down at a super fast rate and you have to replace them. Yes, guns do get worn down, but it's a very small percentage of them that are actually being worn down. People tend to let them wear down, or they tend to replace them because they want to. So the idea is that in general, yes, production should be significantly lower. That's not an actual imbalance, because in general, the question is how fashionable is it to be buying a new weapon. Now, all the other parts that I put included here is I have the total less shotguns. That's primarily because it's going to help us get more accurate numbers in terms of the pricing of rifles and pistols being sold by Smith & Wesson. It's just going to make it a little bit more of a precise measure, especially given the small percentage of the total numbers that are of shotguns as we were seeing against those other charts. And also I wanted to point out that the handgun share as a percentage of the total less shotguns. So you can see in general, the popularity of handguns has grown significantly over the last couple decades, not like a little bit of kind of a downward trend or even super volatile. It seems to be pretty consistently upward, only a couple years where it was kind of dipping down. So the real question is how much of that can be maintained. It probably can't go up forever because this is a share, so it can't go to 100% unless people stop buying rifles. But nonetheless, it gets you an idea of where the directionality is going to go, which again, this also matters for the pricing of each of these categories. Now, this chart kind of combines a little bit of information between the two charts. We have the NSSF adjusted numbers that gives us our gauge for sale, and then we have the total production against it. So you can see the difference between the two, as I was just pointing out. And then we also have the total less of shotguns as a percentage of the adjusted numbers themselves. So you can get an idea of like where the actual percentages of for those specific amount of numbers, how much of it is in that particular subcategory, which in general, it's kind of grown up for a period of time, but it's also come back down at some point in time a little bit too. So you can kind of say maybe 40 as a typical average, 45, depending on the time frame you're pointing it out to. And then the one thing I also wanted to point out, this light green line is actually a more Smith & Wesson specific number. What this shows is units shipped, the Smith & Wesson's units that have been shipped, both rifles and pistols, as a percentage of the total production for the industry. This isn't market share exactly, because when a unit gets shipped is not when it gets sold, since it's going to be sold by the gun store itself. Something you have to understand. So Smith & Wesson can front load some of its production and have it be shipped out. And then also, as we were talking about, guns can last for a very long period of time. So the guns being sold in the actual market share is not going to necessarily be one-to-one with the production numbers. There's really just going to be more like a relative ratio. So nonetheless, a relative ratio in sort of the range of 20% for Smith & Wesson. And that's going to be important for us, again, also building up the model. This last chart is looking specifically at just some Smith& Wesson information. Backdropped against it, we have the kind of bluish gray shade, as well as the orange shade and the light yellow shade, which shows the relative share of revenue for Smith & Wesson of their accessories versus long guns and handguns. So you can see in general, they sell a majority handguns, pretty consistent in terms of the actual trends over the 10 years that we can see right here. And then also in the lines themselves, you can see the price per unit for each of these categories on average. So for long guns in general, you can see a little bit of a downward dip for the prices over a consistent period of time, not super fast, but a downward pacing in terms of pricing until we reached an inflationary period where it started to pick up a little bit. Handguns, a little bit less of a downward movement, but still some sort of slow meandering of sideways, if not slightly downward, to then also spike up a little bit in terms of the inflationary period. And then their accessory pricing remained a little bit more stable over the entire time frame. And this is something that I kind of wanted to point out, because if you actually take a look at the way gun prices move over a long enough period of time, which is hard to get super great information for this, the blue line and the red line on this chart are actually a little bit more like in kind in terms of thinking about the prices of pistols and rifles, but unfortunately that information only existed for like a 6 to 7 year period on the Federal Reserve website. But the best proxy I could find for getting similar code movements going backwards is the small arms manufacturing measure, which is on the purple line, going backwards to even the 1970s, which I think at least paints the picture of what I was trying to show in that previous chart, which is to say that there often is these long periods of time where gun prices are very stable, very, very flat, if not slightly downward in a slightly deflationary trend over time, until we reach a period of inflationary pressures where then the prices will spike up in a little bit of a step up kind of process. You can see this even going back in the 70s when we had higher inflation. The prices were moving up at a rapid pace. And then when the inflation moderated, it really, really leveled off for a period, even starting to go down at some periods in time until we reached high levels of inflation again, and then periods of no inflation again, and then periods of inflation again. So the point is I would say that the price movements for firearms is likely to be coincided with inflation, but leveling towards the downside, not a very high level of growth nonetheless. But then outside inflationary periods, we should expect it to be relatively stable. All right, so coming to take a look over at the model that I built for this company, we start at the top with the US population. As I was talking about, we're really going to be building our projections, assuming sort of a similar as is approach to the gun industry, assuming that everything's going to return to kind of the longer term normals of the trends in terms of like how much gun ownership there is in terms of the US population. And with that, we have a projection for where the US population is going to go for 10 years from now. So with US population as it is, we're expecting it to grow to about 359 million by 2032, according to government estimates. And you can see also then below that, I have the units being shipped by Smith & Wesson on any given year in terms of the handguns, and then also the long guns below that, with the price per unit being put below that as well. Then I have the total revenue being combined with those measures themselves. And then down below that, we have some of the measures that I was talking about, the background checked information, as well as the adjusted measures, which is how I'm basically going to be building this model up. I use as much of the monthly background checked information that I could get my hands on, and then basically took quartiles of that information to say is like, what is the typical monthly amount of background checks that you might be able to expect on any given basis, a wider range of these things. And we'll just kind of assume that we're going to be going back to the more typical ranges of levels of background checks on a regular basis we'd have. Then I took a measure of those background check measures as a percentage of population based off the population data in each of those years. And then that's what I really wanted to base it off of, right? Because it doesn't matter the specific amount of background checks. The question is how much background checks relative to the population. So really, that's actually the measure that we're going to be building it off of specifically, because like I said, we have a forward measure of where the population itself is going to go. Then we had the adjusted figures of background checks, which is our actual proxy for the population or for the demand of gun sales, as we were talking about. And then similarly, I didn't do it as a percentage of the population, but we did it as a percentage of the unadjusted numbers. So we want to say it's like, okay, over any given period of month, how many background checks are likely to be done, and then what percentage of those background checks does the NSSF adjusted numbers typically assume is going to be actually a gauge of the demand of gun sales, which we were saying it's typically about half, but I want to see what the actual numbers say. And so then based off of that, we can get an actual measure of how much gun sales we're going to be expecting in 2032. With, like I said, the assumptions based off of percentage of population, we can come over and see that basically it's a percentage of the year in 2032 on general quartiles expectations. I could do a bear case assumption of maybe 7.4% of the population would be getting background checks versus on the high side, maybe 10.2% or anywhere in between. And so that gets me to 26, 27 million in total background checks in 2032 in the bear case, maybe 36, 37 million in the bull case. If it's going to be a regular percentage of that, maybe down to 47%, maybe on the high end, possibly 57, 58%. I'll combine those metrics together. I end up with about 13 million on the low side for NSSF adjusted demand levels, up to possibly 21 million on the bull side in case of that. So there you go. It's like we can assume that maybe it could be about 13 million to 21 million in gun sales in 2032 per year on kind of like an average regular basis. Who knows what it'll specifically be in 2032 itself. And so then based off of that, we look at what the regular production numbers were like and make projections also based off of the regularity of that. I was talking about the percentage of production numbers as a percentage of the adjusted total of background checks. And so based off of that, the levels of production that we might typically see based off of those levels of background checks is about maybe 35% of the adjusted background checks, maybe 54% of the adjusted background checks, which gets us maybe 4.4 million in rifles and handguns, or possibly 11.3 million in rifles and handguns. If I then base it off of the typical changeover between the rifles and handguns, leaning more towards the recent numbers, because as we were talking about, handguns have become more and more popular. So we'll lean more into the recent averages of those figures. And then that gets us to possibly 3.1 million handguns, up to possibly 7.9 million handguns, along with 1.3 million rifles, up to possibly 3.4 million in rifles. So that gets us to essentially our total market size of the firearms industry that we're trying to focus on, specifically handguns and rifles. And then I also was talking about how the production typically is of a percentage of these numbers themselves. And I took a measure of that. As I was saying before, it's typically kind of like the mid 20s range, and this shouldn't be thought of as a market share. It's more of as a relative production relative to the actual numbers themselves. For Smith & Wesson, this in terms of handguns, this typically ended up being around 28%. For long guns, it ended up being typically around 10%. And I just kind of aligned with those typical figures. But based off of those ratios, that means Smith & Wesson would sell about a little bit less than 800,000 handguns in 2032 in the worst case scenario, to possibly up to 2.5 million. Likewise, with long guns, it'd be a little bit less than 100,000, or possibly close to 500,000 or so. Then we took a measure of the average price per unit, as we talked about for both handguns and long guns. And I took a measure of what the average was over the last several years, because I didn't want to base it off of the volatile prices of the most recent period. And then we took an average of what the growth has been over that time frame. For handguns, it's been about 2.1% per year over the 10 years that we have for Smith & Wesson. For long guns, it's been about 1.2% per year, which is pretty much in line with those like inflation, but maybe even slower than inflation growth rates that we were talking about in the longer term charts. And so I'm basically going to be running off of growth rates similar to that, on average about 2% for handguns, and on average about 1% for long guns. If I combine all those measures together, that gets us revenue for handguns of anywhere from about 300 million to possibly to 1.2 billion. For long guns, anywhere from less than 50 million to possibly 260 million or so. Then we also have other revenue, which includes accessories and stuff like that. So what I chose to do was take a measure of how much dollars of revenue on average that they've typically gotten as a measure relative to the total gun units that they sold, but of combined guns and long guns, and which for the last several years has been on average about $28. And for the last several years also, it grew at about 3.5% per year. I'm going to assume that it's going to have similar growth rates of about 3.5% per year. And that gets us to a range of about anywhere from $37 per accessory unit to possibly $48 per accessory unit. And we'll just base our projections off of that. Combine all three segments together, and we end up with worst case scenario revenues for Smith & Wesson of a little bit less than 400 million in 2032. And in the best case scenario, we end up with 1.6 billion in 2032. Now, if I actually take a measure of this number gauged against the estimated numbers of actual demand that we saw in terms of the adjusted figures, so the actual units that they have against that, we can get a gauge of where we think the market share is likely to be for the company. And based off of these projections, my estimate for market share in 2032 for Smith & Wesson would be about 10%, anywhere from 7% to 14.5%. And I will say that gauged against the comments that the management makes, they talk about their market share usually by category of long gun versus handgun, but they typically report their market share anywhere between 10 and 15%. So I think these assumptions are actually pretty reasonable in terms of market share, and then also in terms of the actual macro perspective of the population growth and the background checks against that. Again, we're basically just assuming that everything returns to the longer term norms of gun ownership for the last couple of decades. Coming over to take a look at some comparative operating metrics for Smith & Wesson, we have Smith & Wesson up against Ruger as well as Vista Outdoors, which are two somewhat comparable companies for them that we can look at their metrics for. I have gross margins here. In general, we can see that Smith & Wesson has stronger gross margins than either of these two. Then if we come to take a look at their EBIT margins, a measure of their operating income, we can see somewhat similarly, Smith & Wesson has pretty strong operating margins against these two, with a few years that they lag behind Ruger's, then taking up again up in 2021, lifting up a little bit more. We haven't got Ruger's report for their most recent annual report, though I think that should be coming out here somewhat soonish. Then switching to asset turnover, a measure of capital efficiency, we can see somewhat similarly, Ruger actually was pretty strong for much of this period of time, though you can see that their asset turnover was really starting to come down over this time frame. Smith & Wesson had a little bit of lower of a figure for much of this time frame. Then it really went through a transformation once they reorganized their business a little bit, and now it's been a little bit stronger than their comparables over this time. And then now taking a look at liabilities as a percentage of assets, what kind of risk or leverage are they taking on in order to try to generate these types of returns? I would say Smith & Wesson at the start of the time series, you can see in general actually had more liabilities typically on average than the comparables we have here. And then that has consistently moved downward over time, which is really, really good to see. Ruger has somewhat moved downward over a lot of this period of time, though it looks like they've gone up ahead of Smith & Wesson in the last year. I'd be curious to see where they are with their new annual report coming out. Then switching from operating measures to market measures, we have similarly the EV to EBIT as well as the PE ratio for these companies. And then I also have POWW, which is not super comparable in terms of their operating metrics, but I did want to try to get as much pricing information in right here. And we can see in general over this time series, you can see that the means that these companies trade in is typically around the kind of 10 range, maybe into the low teens for some of these, even the low single digits for or the high single digits for some of them. So now let's take a look at the DCF template for this company, and likewise with our expected revenues, you can see that the bull case assumption revenue, a little bit less than 1,600 we have right here, about 800 million for the base case assumption, and a little bit more than 400 million for the bear case assumption. I'll say in the short term, I relied mostly on analyst expectations. Though, as I was talking about, if you rely on some of the longer term assumptions we talked about, as well as the background check information that does come out on a monthly basis, you can actually take a look at maybe a forward estimate based off of the few months we've already gone into the next year, what you yourself might be able to think of where the revenues could be this next year itself. And based off of that information, I think the analysts themselves might be sandbagging it. But nonetheless, I still base this valuation closer to the analyst numbers than even some of the higher levels that I think we could possibly see over the next year. With that, though, coming down to the cumulative growth cases, you can see how they look on the charts. In general, it's like our base case assumes a pretty significant amount of growth, but there is some potential that they have actually a ridiculous amount of growth, but there's also some potentiality that they have continual decline over a whole decade from this time frame. Switching over to margins, this part was a little bit tricky, especially given the high levels of volatility within their operating margins over time. Though, as we had seen, that they've really shifted their capital structure, lowering their liabilities, which should give them the ability to have a little bit more consistency in terms of that, at least in terms of like where their gross margins are. But nonetheless, in the short term, I have their operating margins be a little bit lower than they typically have been, about 15% on average for the first 5 years, then going to about 18%, which is their longer term average for the next 5 years after that. And then in the terminal year, it ends up at about an average of the 16%. So we're assuming in the long run that profitability will diminish. And in the short run, they will have lower profitability. But over the whole projection period, it'll be somewhere in the range of where they've typically have been historically, if not maybe a little bit lower. You can see that on the charts with the operating margin cases over here, and then the income distribution for operating income in the terminal year, you can see is a little bit split, a little bimodal in terms of the actual distribution. Switching to capital expenditures and free cash flows, the returns on invested capital that I'm projecting for the next 5 years is about 12 to 13%. And then it'll come up to possibly about 14 to 15% for the years after that, ending in a range of about 13%. Free cash flows we're expecting for the next 5 years on average of only about 17 million per year. We're going to have negative free cash flow years according to our projection in order to achieve some of the growth that we've talked about. And then in the 5 years after that, we end up with average free cash flows of around 100 million per year. So a huge acceleration in free cash flows are seen in the back half of this projection. In the terminal year, we're assuming numbers somewhat similar to that. You can see the projections for the returns on invested capital over time, and then those capital investments that are needed in order to generate those returns that we're talking about, and then the free cash flow distribution as it ends up in the terminal year. Then coming over to the discount rate page, you can see with our operating assumptions, we end up with pretty high levels of excess returns in terms of expected against the returns on invested capital. And the implied terminal multiple assumptions that we end up with ends up with a pretty wide range between about 10 and 17, with the vast majority of outcomes sitting in this kind of 10 to 13 to 14 range or something like that. And that gets us a distribution with about 50% of the expected values of it being currently worth between about $21 on the high side to possibly around $14 on the low side. The median case being about $18 per share, expected case being a little bit lower than that, with the expected expectations that if you were to buy it today, assuming my assumptions are correct, you could end up with about 50% of outcomes anywhere between 9 and 14% expected returns per year for the next decade. Fair value distribution, you can see as it looks right here. Yeah, large amounts of the value kind of clumped around where it's currently at, but we see even more potential likely values significantly to the upside of where it currently stands. See the expected return distribution likewise right here. Switching over to the final page, you can take a look at the summary DCF page where you can see the expected cases for each of these metrics as it currently stands. With the current share price around $13 per share, that gives the current fair value about $18 per share. It currently sits at about 21% in the fair value distribution, which means that if you buy it right now, we effectively see 4 times as many chances to the upside as there is to the downside. 37 to 38% on average upside, 12% expected returns per year for the next 10 years. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it with our valuation of Smith & Wesson brands. It's always good to cover a company that is a major holding within our portfolio, and I hope you guys enjoyed this valuation. As I said at the start of the video, it is already one of our major holdings, so I'm not necessarily buying it today because I don't want to be over allocated to it today. But if I didn't already have a position in it, I would definitely be interested at these prices. I'll catch you all in the next valuation. Bye.